It's September 2008. A 158-year-old bank just collapsed overnight. $600 billion gone. Retirement accounts vanish. Millions lose jobs. But here's the kicker. The real domino started with a billboard-sized lie. Why rent when you can own? Cue the upbeat soundtrack. Fast forward to 2002. America is still nursing wounds from the dot-com crash. 9/11 punched the economy in the gut, and Wall Street is on edge. But don't worry, the Federal Reserve has a plan. Cut interest rates to almost zero. Boom! Credit is cheap. Borrowing is a breeze. And suddenly, the new national pastime isn't baseball. It's buying houses. Congratulations! You just got approved for $500,000, but you make $40,000 a year. Not a problem. Adjustable rate, balloon payment, ninja loan. What's a ninja loan? No income, no job, no assets, no problem. See, in the early 2000s, homeownership wasn't just about a roof over your head. It was the American dream, stability, status, suburban bliss. And the message, louder than any billboard, was, why rent when you can own? Banks agreed. Hell, they agreed so hard they started handing out money like it was candy. Everyone was winning. Enter the subprime mortgage. Translation: loans for folks with bad credit, patchy incomes, or zero clue about money. Bad credit, no credit, living in a van, you're approved. For a luxury condo, should you worry about paying it back? Not your problem. If you default, the bank just sells the house. At a profit. It was a housing gold rush. A frenzy. Everybody buys. Prices rocket. The house next door doubled in 6 months. Normal. Even the McDonald's part-timer with $5 in savings qualifies for a mortgage. Just a normal 2000s day. And the rules? Out the window. Traditional lending standards? Too slow. Risk assessments? Too boring. Down payments? Optional. If you had a pulse, you had a mortgage. People bought houses like ramen noodles. Lenders printed loans like monopoly money. Mortgage brokers made commissions faster than they could say, bubble? Behind the open house tours and granite countertops, a question hovered. What could go wrong? Spoiler alert, everything. By 2005, home buying isn't about stability anymore. It's about flipping. Real estate isn't shelter. It's a lottery ticket. Buy, flip, profit, repeat. The more people joined, the higher prices soared. It was like trying to extinguish a fire by pouring gasoline, and everyone held a match. But beneath the glowing veneer, rot. Those subprime loans everyone devoured? They were awful. Totally awful. High risk plus no credit checks plus hardly any income verification. But the folks on Wall Street had an epiphany. Let's turn this into gold. Enter mortgage-backed securities, MBS. Bundle all that junk, wrap it prettily, sell it to investors as safe. Ratings agencies slapped AAA on them like trading cards. This one's got unemployed gym bro and barista loans? Sure, AAA. The kicker: the ratings agencies were paid by the banks whose loans they rated. And Wall Street didn't stop. They mixed in those shaky bundles into something even more sophisticated: collateralized debt obligations, CDOs. Through financial alchemy, trash loans became investment grade. Of course, some oddballs, skeptics, and troublemakers read the fine print. They asked, what if we bet against this? Problem: there was no product to do that. So they marched into Wall Street's marble halls and said, these loans are garbage. We want to short them. Build us something that pays if they go bust. Wall Street laughed. You want to bet against the housing market? Cute. Fine. Here's your insurance. You pay a monthly premium and we pocket the cash if nothing happens. Because hey, the system will never collapse. Right? So they rolled out the big risk. Credit default swaps, CDS. Insurance contracts that pay out if those MBS/CDO bundles blow up. Weird part: you didn't even need to own the asset to buy the insurance. It was like buying life insurance on your neighbor's grandma and rooting for her to slip on the stairs. The whole thing was a Jenga tower built of lies and leverage. Each block, a bad mortgage. Each level, a bigger risk. And at the very top, another bonus. Who needs ethics when the easy money flows? Whistleblowers ignored. Regulators asleep. and the top dogs too rich or too greedy to stop. The party raged on, while the floor quietly cracked underneath. A missed mortgage here, a Vegas condo empty there, and then the wave came. Suddenly, home prices dropping. But housing always goes up, right? That's what we were told. This is basic economics, except now it's wrong. For years, the system was a Jenga tower made of lies, leverage, and wild optimism. In 2007, someone yanked the wrong block. The subprime loans, those shaky, rotten deals wrapped in glitter, started to implode. The MBS built on them? Ticking time bombs that exploded. Banks stuffed with safe assets realized they were holding radioactive waste. We can't sell this. The market's frozen. We're screwed. Panic spread like wildfire. Hedge funds bleeding. Investment banks slashing billions in losses. And then, boom, Lehman Brothers, a 158-year-old institution, gone. No bailout, no hero, just a $600 billion crater on Wall Street. The message: if Lehman can die, anyone can. Overnight, banks stopped lending to each other. Credit markets froze. Families couldn't get mortgages. Businesses couldn't borrow. Retirees watched pensions evaporate. By late 2008, total collapse mode was on. Millions unemployed. Foreclosures soared. Household wealth vanished. Homes underwater. People furious. Wall Street got their bonuses back. Main Street got pink slips and food stamps. The system survived. But trust burned to the ground. Because if 2008 taught us anything, the next crisis doesn't look like the last one. It looks innocent, until it isn't.